Hi, this is the second part of Basic Accounting Knowledge course. In this part, we are going to talk about why we need accounting, and before that, we will discuss about the pre-assumptions. Then we are going to talk about the types of accounting, which are financial accounting and managerial accounting. And the most basic concept of accounting is double entry bookkeeping. Before we start to discuss why we need accounting, we need to understand some basic things about the business environment. The first one is that a business entity is a separate form from the personal affairs of its owners. So simply, we are not going to talk about the people who are the owner of the business, but we are going to be talking about the business itself, like a separate entity. Each business should be evaluated based on something, right? I mean, some activities, maybe, well, the income, maybe the success. But how we are going to be measuring the success, or how we are going to be comparing different companies, if, for example, if we want to invest some money in a company. Therefore, we need some basic standards, some basic concepts for all of the businesses to apply. In the business, in any type of business, each activity should be recorded in some terms. Usually this term is the money. And monetary transaction should be recorded in a systematic way to keep record of them later on and to make sure that all of the companies are following same type or similar types of standards. Because both the business owners, also the outside authorities like government, or let's say you're going to be applying for a loan, then in that case the bank will be an outsider, are going to be interested in the historical data that we have. This historical data should have been recorded in the accounting system. So historical monetary based data is the common output of the accounting. If you look at the definition right now in here, this is going to be pretty broad. So practice and body of knowledge concerned primarily with methods for recording transactions. So we are going to be recording some transaction, and to record the transaction, we need a monetary amount. And we are going to be keeping financial record, performing internal audit, reporting and analyzing financial information to the management, and advising on taxation matter. It is another definition is it is a systematic process of identifying, recording, measuring, classifying, verifying, summarizing, interpreting, and communicating financial information. So it reveals profit or loss for a given period and the value and nature of the firm's assets, liabilities, and owner's equity. Actually, these concepts, as I said, it is pretty broad, so we can actually divide it into different subfields. The most common division is based on managerial accounting and financial accounting, so based on functions. But also there are some other subfields like audit, internal audit, or independent audit. And also, maybe internal control, maybe taxation will be another department or another subfield as well. But we are going to be discussing about financial accounting and managerial accounting. So these two are the most common types of accounting. And in here, when you see identifying, recording, so identifying some transaction, then recording them, then measuring and classifying and summarizing, interpreting them, these are going to be the topics of financial accounting. On the other side, for example, reporting and analyzing financial information to management, it is going to be based on some concepts under managerial accounting. And advising on taxation will be another issue. Actually, we can count it under financial accounting, but actually it is completely a different subfield. So if we distinguish between managerial accounting and financial accounting, we need some dimension about why these two are getting separated from each other. First of all, their purpose is different. In financial accounting, we are simply recording the transaction and summarizing them and preparing some information for outsiders usually. So in financial accounting, we will be communicating financial position to outsiders. On the other hand, under managerial accounting, as it is pretty clear on the name, we are producing information for management, not for outsiders. Because of these different purposes, also the primary users are different. Managerial accounting primary users are mainly internal managers, so insider of the company. On the other hand, the primary users of financial accounting information are external users like shareholders, bondholders, maybe government, potential investors, and so on. The focus is also different for these two. So in managerial accounting, we're usually looking for some future-oriented information. So simply, we're trying to project for future, for example, trying to develop budgets. And then when we have the actual numbers, we are going to be analyzing the variances. So this is usually future-oriented. On the other hand, in financial accounting, what we are doing is actually we are keeping record of all of the transactions. Based on them, we are summarizing the information that we have accumulated. Then we are preparing the financial statements. And financial statements are covering some historical data, not future-oriented data. For example, there is no budget under financial accounting. Depending on the types of accounting, the rules are also different. So because in managerial accounting, we are providing information to the managers, we don't have to follow any certain rules or any type of legislation, any type of standards, simply because we are providing information to insiders. So depending on the manager's need, we can provide any type of information. For example, you can use any type of costing method you like. On the other hand, under financial accounting, as I said, we need the companies to follow some certain standards. Therefore, all of the companies are subject to some certain standards, like general accepted accounting principles or international financial reporting standards. Depending on the time span, simply in managerial accounting, it is ultra current to very long time horizon to the future. On the other hand, financial accounting is primarily deals with the data, historical data for monthly, quarterly, or let's say annually information. So simply we are providing the information in a monthly basis, for example, for tax purposes, or quarterly for income statement or for reporting to outsiders. And definitely we are going to be reporting some annual reports as well to outsiders. So financial accounting is the process of identifying, recording, summarizing, interpreting, and communicating financial information. So simply in here, the first step that we are going to be doing, we need to decide about what is going to be recorded. So we need to identify the transaction. If there is a monetary amount, if there is a cash inflow or outflow, then it means that we need definitely to identify it and record it in the accounting system. Then, of course, we are going to be keeping record of many transactions in, for example, in a month. Then we need to summarize this information based on something, based on maybe the accounts that we use, based on if it is cash, it requires cash inflows or outflows. And then based on that information, we are going to be interpreting, then developing financial statements to communicate this financial information that we have been generating to outsiders. On the other hand, in managerial accounting, we are dealing with a process of identification, measurement, accumulation, analysis, preparation and interpretation and communication of information used by management not for outsiders anymore. It is used to plan, evaluate, and control within the entity, and we are using this information to make sure that the company is using uh, the resources appropriately and accountably. So the basic concept, the most basic concept for accounting is the double entry bookkeeping. This is something that we are using in financial accounting. So this is the concept underlying that. Well, when we record monetary transaction based on the historical data that we have, one transaction affects at least two different accounts, which means that we are going to be recording something in at least two different accounts. For example, if you get money from the bank to your cash account in the company, then simply the money will be reducing in the bank and your cash in your hand will be increasing. Or let's say you have money and you purchase some inventory. Simply the cash account will be decreasing because you pay cash to purchase the inventory. An inventory account will be increasing. So as you see, there are at least two parts getting affected. Actually, we are using double entry bookkeeping to satisfy accounting equation. This is the common concept, the most basic concept of accounting. It relies to actually, it refers to balance sheet data. Simply assets are going to be equal to liabilities plus equity. It means that what we mean by asset is that anything that a company has, it might be cash, it might be some receivable that will be collected in the future, it might be inventory, it might be maybe long-term assets like buildings, like rent, like machines. So on the other hand, we need something to afford these assets. It might be liability, like bank loan, maybe some credit purchases from the suppliers. And also maybe you have your own money that we call capital. Then you're going to be using that money to afford the assets. So depending on how you are affording the assets, this equation will be the same. Of course, always assets will be equal to liabilities plus equity, but maybe there is going to be no liability at all if it is zero. If you're affording all of the assets with your capital, then assets will be equal to equity. If you have some liability, so you owe something to outsiders, then you are going to have some liability as well. One example is this. For example, in here, there is a cash account and accounts payable. So simply, in here, the company gets some cash, so cash is increasing. But on the other hand, the loan is increasing as well. So simply cash is an asset, right? And accounts payable is a liability. So asset is going to be equal to liability if this is the only thing that this company has right now. And in the next part, we will talk about the basic concepts and structure of the balance sheet, assets, liabilities, and owner's equity, and we talk about how we can read the balance sheet. Thanks for participating.